Welcome back to the deep dive. Today we are looking at a proposition that, honestly, triggers every single one of my internal scam detectors.
Oh, I think I know exactly which one you're talking about.
Yeah, you saw the headline. The promise is making $800 a month, doing absolutely nothing.
Right.
No trading, no staring at charts at 3 a.m., wondering why a dog coin is crashing, no stress, just pure passive income.
It sounds like a late-night infomercial from, 2021, doesn't it? Buy my course, get rich quick, join my Discord.
Exactly, and usually I just delete that email. But we've got a stack of research here on the state of the market in January 2026, and the data is suggesting something, well, something weird. It's suggesting that this isn't a scam anymore, it's just boring infrastructure.
That is the perfect way to put it. I mean, if you haven't paid attention to crypto since the last bull run, say 2024, you're operating on outdated software. The casino is effectively closed, or at least regulated, and the bank is open for business.
And a big part of that shift seems to be this genius act of 2025 that the sources keep mentioning. I admit I kind of tuned out the news cycle last year. What actually changed there? Why does a piece of legislation matter to a guy trying to make rent?
It matters because it was the moment the U.S. government finally decided they wanted a piece of the pie rather than just trying to ban the bakery.
Ah, okay.
The Genius Act established a clear legal framework for payment stablecoins in the U.S.
So we went from magic internet money to federally regulated digital dollars.
Precisely. And that shift turns stablecoins from gambling chips into what analysts are now calling programmable balance sheet primitives.
Okay, programmable balance sheet primitives. That is a mouthful. That sounds like something a consultant charges you $500 an hour to say. Translate that for me.
Think of a regular dollar in your bank account right now. It's dumb. It just sits there.
Right.
If you want it to earn interest, you have to ask the bank, maybe fill out a form, move it to a CD. It's all manual. A programmable dollar. It can hunt for yield on its own. It can execute strategies automatically based on code.
So my money wakes up and goes to work without me telling you.
Exactly. And because we have that regulatory clarity and things like the 1099-DA forms making tax reporting standard, major institutions are comfortable playing here now. And where institutions go, liquidity follows.
So the mission for this deep dive is to figure out if that $800 a month claim is real. We're going to walk through the hierarchy of yield. We'll start with the easy button, stuff that feels like a savings account.
Yep.
Then we'll graduate to the smart layer of DeFi. And finally, we'll hit the active layer where those like 50% yields live.
And we will break down exactly how that $800 figure is calculated using a blended portfolio. It involves some math, but we'll get through it.
Let's jump in. Segment 1, the easy button. So if I'm a listener who wants my money to work for me, but I don't want to learn how to code or manage private keys, where do I start?
The simplest starting point is centralized finance, or CeFi. These are companies that act, somewhat like banks. You give them your crypto, they lend it out or invest it, and they pay you interest.
Oh,
The gold standard for safety right now is probably Coinbase.
right, the publicly traded giant. I think my grandma even has a Coinbase account.
It's everywhere. Coinbase offers a yield on USDC/USD coin that hovers around 4%. Now, that might not sound explosive compared to the crypto hype of the past.
Well, yeah, 4% is basically a high-yield savings account at a regular bank.
Oh.
Why bother with the crypto risk?
That's the important question. And the reason it's 4% is that the yield is derived largely from the underlying U.S. Treasury reserves that back USDC.
So it's basically just passing on the risk-free rate of the U.S. government, but on the blockchain.
Correct. But because it's on the blockchain, settlement is instant. You aren't waiting 3 days for an ACH transfer. For many, that efficiency plus the safety of monthly attestations by major accounting firms, that makes it the safe haven play.
Okay, but 4% isn't going to get me that $800 a month unless I have a massive pile of cash. I saw mention of Nexo in the research offering way higher rates. They were quoting double digits.
Yeah.
What's the deal there?
So Nexo is what we might call the high-octane alternative in the CeFi space. They manage over $11 billion in assets, so they aren't small. But their model is different. To get those high yields, we're talking 12% or even 14%, you have to participate in their loyalty system.
A loyalty system, like airline miles.
Sort of, but with higher stakes. This is where you need to be careful. To be a platinum user and unlock that 14% yield on your stablecoins, you need to hold at least 10% of your total portfolio in their native token, Nexo.
Wait, pause. So if I have $10,000 I want to invest, I have to take 1,000 of that and buy a volatile crypto token.
Yes.
So if the Nexo token crashes 50%, My safe stablecoin yield gets wiped out, effectively.
That is the risk. You are taking on exposure to their equity, their token, to boost the yield on your cash.
Okay, so there is no free lunch. I'm basically buying stock in the bank to get a better interest rate.
That's a fair analogy. You have flexible savings on Nexo, which pays out daily, or you can lock your funds for up to a year for higher rates. But you always have that counterparty risk. You are trusting Nexo to manage their lending book responsibly.
So that's CeFi. Safe and easy at 4%, or higher risk, higher reward at 12% with some strings attached. But let's say I don't want to trust a company. I want to cut out the middleman entirely. That brings us to segment 2, the smart layer.
This is where we enter decentralized finance, or DeFi, specifically lending protocols. And the big names here are Aave and Compound.
These are the protocols that run on code, not on corporate boards.
Right. Let's look at Aave v4. It's currently offering an average supply APY on USDC of around 7.7%. It's non-custodial, which means you hold the keys. You deposit your USDC into a smart contract, others borrow it against collateral, and you get paid.
And what about Compound?
Compound v3, also known as Comet, is very popular for its base asset model. It isolates risk a lot more strictly. The yield is a bit lower, currently around 4.7%, but for many institutions, that safety architecture is worth the trade-off.
But here's where it gets really interesting for me. The sources kept mentioning this acronym, RWA, Real World Assets. It feels like everyone in 2026 is obsessed with this. What is going on here?
They are, and for good reason. This is the bridge. RWA is all about bringing off-chain assets like U.S. Treasury bills on-chain.
So we're back to treasuries again?
We are. Look at Ondo Finance and their token USDY. It's a tokenized note secured by short-term U.S. Treasuries and bank deposits. It targets about a 5.2% APY.
Okay.
It provides institutional-grade security, but with the 247 liquidity of crypto.
So it's like buying a T-bill, but I can trade it or move it instantly on a Saturday night.
Exactly. And then you have the Sky protocol. You might remember them as Maker DAO. Their savings DAI or SDAI yields between 5% and 7%, backed largely by these real-world assets. It's bringing that risk-free yield deep into the DeFi ecosystem.
Now, there was one specific strategy in this section that caught my eye because of the name, the steakhouse. Please tell me this is as delicious as it sounds.
I wish. Sadly, no actual stakes are involved. But it is a favorite for the yield farmers. It's technically called the Steakhouse USDC Morpho Vault.
It sounds like a secret menu item. What is it actually doing?
It's a curated vault on the Morpho protocol, so think of Morpho as like the plumbing layer. It optimizes lending efficiency. But the Steakhouse part is the management team. They run a dual engine strategy.
Dual engine. Break that down.
Engine 1 is traditional crypto lending. People want to borrow your dollars to buy Bitcoin or Ethereum, so they pay you interest. That's pretty standard.
Okay. High demand in a bull market, low demand in a bear market.
Right. But Engine 2 is the real-world asset engine. The vault also lends against tokenized U.S. Treasury bills.
So it's a hybrid vehicle. It's using crypto volatility for gas, but it has an electric battery made of government bonds for stability.
That is a fantastic analogy, exactly. If the crypto market crashes and nobody wants to borrow money to trade, the vault can pivot and lean on those treasury yields to keep the APY stable.
And the notes say this is yielding about 6.7%.
Around there, on the base network. And the key is that it's curated. You aren't managing the ratio between crypto and treasuries yourself. The risk experts at Steakhouse are doing that for you.
I like that.
Well,
Dual engine yield.
Yeah.
Okay, so we've got safe CeFi, we've got smart DeFi lending, but the intro promised 15%. Where are the big numbers?
The big numbers.
I feel like we haven't hit the get rich part yet.
Right. They live in segment 3, the active layer. Specifically, liquidity provision, or LP.
This is where we stop just lending money and start acting like a market maker.
Correct. And in 2026, the dominant model is Uniswap v3, concentrated liquidity.
Concentrated liquidity. I read the briefing on this 3 times and I'm still wrapping my head around it. It sounds intense.
It's dense, but let's simplify it. Imagine a traditional pool is like watering your entire lawn just to keep one flower alive. You're spreading your capital everywhere, even where it's not needed.
Which seems very inefficient.
Extremely. Concentrated liquidity is like using a hose to water just that one flower. You put the money exactly where the trading is happening.
Okay, so let's take a stablecoin pair, like USDC and USDT. We know the price should always be $1.
Right. So instead of spreading your liquidity from 0 to infinity, you set a range between, say, 0.999 and 1.001.
A tiny, tiny range.
A tiny range. But because your capital is so concentrated, it's incredibly efficient. You capture massive trading fees for people swapping between those two stablecoins. This can boost your APY to anywhere from 8% to 15% or even higher during volatile periods.
But if it were that easy, the banks would be doing it. What's the gotcha? There has to be a risk if the price moves.
The gotcha is if the price leaves that range. Let's say USDC depegs and drops to like 90 cents.
Panic in the streets.
Panic in the streets and panic in your portfolio, because your automated strategy will effectively sell all your good USDT and buy the crashing USDC all the way down.
So I end up holding the bag.
You become the bag holder of the failing asset. That is the risk. It requires active monitoring. You can't just set this up and go to the beach for a month like you can with Aave.
Okay, so let's put this all together. The allocated portfolio. The sources broke down exactly how to hit that 800-month target. Walk us through the math, but break it to me gently. How much cash do I need upfront to make $800 a month passively?
To hit $800 a month safely, meaning a blended APY of around 9.25%, you need a principal balance of roughly $100,000.
Okay, that is not a small amount of money.
It's not, but let's contextualize that. If you had $100,000 in a traditional bank savings account in 2026, earning maybe 1% or 2%, you're making, what, $150 a month?
Right. It pays the phone bill, maybe.
Exactly. With this crypto strategy, that same capital is paying your rent, or at least a big chunk of it.
But how is that $100 case sliced up? Are they just putting it all on red?
Definitely not. It's a diversified slice to manage risk. The example suggests putting the heavy hitter $30,000 into Nexo Platinum to grab that, 11% yield.
Taking the equity risk for the payout?
Correct. Then $25,000 into Aave V4 for that reliable 7.7%. You diversify $15,000 into Ondo's USDY for RWA stability at 5.2%. Another $15,000 goes into that Steakhouse vault we mentioned at 6.7%.
And the rest?
The final $15,000 goes into the high-risk, high-reward Uniswap V3 LP strategy, targeting that 15% yield. When you blend all that together, you get a robust portfolio yielding over 9% annually.
That is surprisingly practical. But let's be real, most of our listeners don't have $100 sitting under their mattress. What if I have $1,000? Is this game even worth playing? Or will fees eat me alive?
If you have $1,000, your enemy is gas fees. You cannot afford to use the Ethereum mainnet.
Right, a $50 transaction fee eats 5% of your portfolio instantly.
Yeah.
That's a year's worth of yield gone in one click.
Exactly. So the $1,000 starter strategy relies on Layer 2 networks. The source specifically recommends using Base or Arbitrum.
Okay, so what's the play?
Step 1. On-ramp your USDC via Coinbase or Kraken. Step 2. Bridge it immediately to the Base network.
Low fees, fast transactions.
Step 3. Split that $1,000. Put $500 into the Morpher Steakhouse vault and $500 into Aave V4 on Base.
Simple.
It's simple, it's low fee, and importantly, you can compound those earnings. It won't generate $800 a month right away, but it builds the foundation.
This all sounds great, but I have to play the cynic again. If I can get 9% or 10% on my dollars, why isn't everyone doing this? We talked about Nexo risk and Uniswap risk, but are there other gotchas hiding in the bushes?
There are significant risks. The first is smart contract risk. Even established names like Aave or Compound run on code, and code can have bugs.
And we've seen hacks in the past where protocols get drained.
Plenty. It's rare for the blue chips, but it's never zero. And then there's depegging risk. If USDC loses its value drops to 90 cents, your safe yield means nothing because your principal just took a 10% haircut.
And then there's the fun part, taxes. I heard the 2026 tax season is going to be brutal for crypto people.
It is. The 2026 tax reality is very different thanks to those 1099 DA forms. Brokers and even some decentralized interfaces are now required to report digital asset transactions to the IRS.
So the days of flying under the radar are officially over.
Completely. The government sees everything. Yields are taxed as ordinary income. And there's new legislation that may apply wash sale rules to crypto.
Wait, explain that. That sounds important.
In the stock market, if you sell a stock at a loss and buy it back immediately, you can't claim that loss on your taxes. Crypto used to be exempt from that.
Right. People would sell Bitcoin, harvest the laws, and buy it back 5 minutes later.
That loophole is likely closed or closing. If you buy a substantially identical asset within 30 days, that loss is disallowed. It changes the trading strategy significantly. You can't just harvest losses to offset your gains anymore.
And we can't talk about risks without mentioning security. If I'm doing this be your own bank thing, I assume I need better security than just a password that is password 123.
If you are doing self-custody using a Aave, Uniswap, Morpho, you must use a hardware wallet, a ledger, a Trezor. If you are interacting with these protocols using just a browser extension on a hot wallet on your laptop, you are asking for trouble.
So hardware wallet is mandatory.
Got it. It's the seatbelt of the crypto world. You wouldn't drive 100 mile for without a seatbelt. Don't yield farm without a ledger.
All right, let's wrap this up. We've covered a lot of ground. It seems like the Wild West has been paved over with concrete.
It has. You have 3 clear tiers now. CeFi for Ease Nexo and Coinbase, RWA and Vaults for Stability Ondo and Stakehouse, and liquidity provision for maximum yield Uniswap v3.
And the big takeaway for me is that this isn't about gambling anymore. It's about infrastructure.
That's the key insight. In 2026, liquidity is the truth layer of the market. The opportunity is no longer about betting on a coin price going up. It's about acting as the bank for the internet economy. You are providing the liquidity that makes the system run, and you are getting paid for that service.
Which leads us to a pretty provocative thought to leave our listeners with.
If we connect this to the bigger picture, think about what we just discussed. We have stablecoins generating higher yields than traditional bank accounts, but they are often backed by the same underlying assets, U.S. Treasuries.
Right, the same collateral, same T-bills.
It is. The only difference is the delivery mechanism. Crypto cuts out the middleman, the bank branches, the legacy IT systems, the overhead, the CEO bonuses. So the question is, how long until traditional banks are forced to run on these rails just to survive? Because right now, the internet is offering a better deal on the dollar than the bank is.
That is something to chew on. The bank of the future might just be code, and the tellers might just be us providing the liquidity. Thanks for tuning in to this deep dive. We'll see you next time.